Now, April 2023, question 1A. The static trade-off theory of capital structure. I know that one you can get. Kama umeanza kusoma theory. Kama hujaanza unashangaa ni nini, si ndio? Kama umeanza ama bado ziko safe ndani ya group. Nepata mizi download. Unajua kitu kitumwa kwa group na usipo download kwa inapotea. Lakini usijali kupotea ni side chat tupeke kwa group. Kindly send again. Ila mtajua yangu hujaifungua. Una ni side chat uniambia please mwalimu ndio nikujue. Share these notes again. Hata nikikujua na ni share, si ni sawa? Kwani nitakuchapa? Now, selected financial information for Temple Limited is shown below. Yield to maturity on debt is 8%. Market value of debt is 100 million. But the yield to maturity inatusaidia kupata KD. Remember for the redeemable debt, KD ni YTM, we adjust for tax. Number of ordinary shares 10 million. Market price per ordinary share is 30 shillings. Cost of capital if all equity financed 10.3. Marginal tax rate is 30%. Johnson, a financial analyst, expects that an increase in Temple Limited's financial leverage will increase its cost of debt and equity. Based on an examination of similar companies in Temple Limited industry, Johnson estimates that the company's cost of debt and cost of equity at various debt to total capital ratio are as shown below. So debt to total capital, by the way, debt to total capital is on a debt to assets. Total capital is debt plus equity. So debt equal 20%. It's 20 over 100. Total capital is 100%. So debt becomes 20%, equity becomes 80%. Cost of debt and cost of equity. Determine the debt to total capital ratio that would minimize Temple Limited's WSCC. Eba sasa hapa nini ilikuwa noma. Kizungu mingi ndio inakutisha. So tuko na debt, tuko na equity. WSCC equals to weke plus what? WDKD. Kwa jasema ni pre-tax KD. So let's pay the KD. By the way, hizi ni free marks. Wanasema ni before tax. Our estimates of Temple before tax cost, yeah, pre-tax. So here we adjust forward. We adjust for tax. So debt ni 20%, equity itakuwa 80%. Hiyo ya kwanza, si ndio? So the weight of equity is 0.8. KE ni ngapi? 12.5. Weight of debt ni 0.2. Pre-tax KD ni 7 point. Adjusted for tax. Unapata WSCC. Unaenda kwa ya pili. Debt ni 30%. Equity ni ngapi? So the WSCC is 0.7 times 13 plus 0.3 KD ni ngapi? 8.4 adjusted for tax. Sasa tujiulize ile kizungu mingi hapo vile ilikuwa ya nini? Scarecrow. No scarecrow. Na naona walikuwa. Yeah. Just interpret the question, then try to use the information that is the question. Use the information that you need. Si lazima utumie zote. Sasa, you just interpret it. Then you ask yourself, what do they want? They want us to give them the debt to assets ratio, the debt to total capital ratio that would minimize the WSCC. So after getting the WSCC, we shall get the one that the WSCC is the lowest. Alafu answer wanataka nini? Debt to total equity. Debt to total capital. So kama video itakuwa the lowest, then unamwambia to the optimal debt to total capital will be what? 20%. Sasa Sio unaweza malizia exam room. Haya, achia hapo basi. Twende kwa mergers and acquisition. Portfolio swali umejaribu ikakulemea? Ama bado unajaribu tuulizane Tuesday? You need the weekend. Haya, sawa. The weekend simuona mko hapa. Don't worry. It's for a short time, ndio? It's for a short time. Sasa kama ile weekend ya mwisho pia tukuje Sunday mzima. Niache ujinga. Mergers and acquisition. Ngoja sasa hivi. Leo tupike saa 3. Let's come up. Ama the special question. Hebu semengi kwa sauti at leakage. Tuandike kwanza mergers and acquisition kwa new page. Lakini ukianza kusema sasa hivi utasahau topics nyingine. Now we'll just highlight a very few something very briefly about the mergers and acquisition to help us dig into the computation part. Now we can say this: a merger refers to a combination. A merger refers to a combination of several companies into one while an acquisition arises when a stronger company known as a predator arises when a stronger company known as a predator. You can be predator ama predator. Takes over another company known as a target. Takes over another company known as a target. Full stop. The predator maintains its identity. The predator maintains its identity. While the target loses its identity. While the target loses its identity. So when it comes to merger, company A and company B comes together to form company C. That is a merger. An acquisition, company A brings in company B, but company A the new company will continue trading as A Limited. So we are absorbing a smaller company to be part of us. We maintain our name, but now the other company loses its identity. Although there's some mergers where we can bring you in and you'll continue operating using your name, but under us. Yeah, it has happened with the banks around, right? National Bank and KCB. Yeah. Types of mergers. Have you gone types of mergers? Moja ni gani? Chatoni nyali download notes. Types of merger. Kuna vertical, hata sitauliza inafanya aje. Naiba kama kuna vertical nyingine ni gani? Hata kama hujaisoma by all means, ndio. Na kama kuna vertical na horizontal nyingine inakuwa? Sikia naiba sema diagonal. Ingine ni gani? Depending on the group of schools that you went to, can help us pronounce it. Ikikataa kwa exam kwa ongeani. So the vertical merger, horizontal merger, conglomerate merger, and congeneric merger. Now, vertical ni ile imesimama, si ndio? Vertical lines ni ile imesimama. Horizontal ni ile imelala. That is true, right? So a vertical merger is a merger between companies that are in the same line of production. A merger between company A that provides raw materials and company B that uses the raw materials of company A. A merger between Bamburi Cement and a road construction company. We are in the same line of production. That is a vertical merger. A merger between companies that require each other for survival in the same line of what? Production. That is vertical. Horizontal merger, imelala. A merger between competitors. A merger between competitors. We are operating at the same level. We are coming together. We are forming a horizontal merger. So, regional college merging with another college that offers the same courses as ours, that one becomes a horizontal merger. A merger between competitors. A merger between companies in the same line of production. The raw materials of company A are used as the finished goods of company B. We are coming together. So, just to eliminate some barriers, some trade barriers, to ensure that the raw materials are always available, to ensure that the raw materials are available at a cheaper price, because we'll be buying from our own. The horizontal merger, the objective to eliminate competition. Then the conglomerate merger, this one explains the concept of portfolio. Conglomerate merger explains the concept of portfolio theory. Portfolio theory, you are bringing many investments together that are perfectly negatively correlated, with an aim of what? Maximizing the return, minimizing the risk. That's how. So conglomerate merger is a merger between companies that are not related at all, with an objective of diversification. The diversification is in portfolio. That's how. Then of course the congeneric merger is very close to horizontal merger, but it's a merger between companies that provide alternative products serving the same purpose. Like if a company that produces Nescafe merges with a company that produces cocoa, they are serving the same purpose but different products. Sasa, so hii na hii zinakaribiana na ziko kwa notes. Ziko kwa notes zimetaipiwa in black. Now, kindly pitia notes tutazielewa vizuri. We also have something to do with the defensive tactics as a target farm. What can I do to avoid or to protect myself against a hostile takeover? When somebody is too hostile and is approaching you, what can you do to run away from that person? The defensive tactics. Moja ni gani? Kuna poison pill, will not even tell you to explain. Ziko kwa explanation kwa notes. Ingine? There? Crown jewels is also there. Any other? Kuna white knight. Golden parachute iko hapo. Nebo nataka kusema ingine? Pac-Man defense iko hapo. There? It is also there. Kuna ingine? Nebo umeziona hizo notes? Sisemi wewe, nasema kila mtu. So they're there. Kindly, and they're zinatestiwa by the exam. Go through the first paper, you'll see them. You'll see those questions. So it here is on notes. Now, let's give me a small subtopic on forms of consideration. Forms of consideration in mergers and acquisition. Forms of consideration in mergers and acquisition. Let me say, when paying for the acquisition of the target firm, when paying for the acquisition of the target firm, the predator, when paying for the acquisition of the target firm, comma, the predator can use any of the following forms. Can use any of the following forms. Number one, cash transaction. Cash transaction. So we acquire the target firm by paying the shareholders of that firm. Then number two, share to share. Share to share transfer. Share to share transfer, i.e., the predator offers a given number of ordinary shares, a given number of new shares. The predator offers a given number of new shares for every existing share. For every existing share in the target firm. For every existing share in the target firm. So here it ongeza the number of shares. When this company is coming in, we are offering them some shares. So they are coming in as shareholders. They also be part of the shareholders of the predator. Then number three, use of fixed income securities. Use of fixed income securities, i.e., debentures or preference shares. Debentures or preference shares. Then you put a dash and you say, the predator shall offer a given number of fixed income securities, for every existing share, of the target firm. For every existing share of the target firm. Great. Another subtopic, valuation of the target firm. Valuation of the target firm. Let me say, when determining the value of the target, the following models can be used. When determining the value of the target, comma, the following models can be used. Number one, we have price earnings, that is PE. ratio model. PE ratio model. Remember the formula of PE ratio? Do you remember? So that if you remember, you can come and recall. Can't miss out the recall. PE ratio equals to the things that made you reach here. Would you exempt it? Then P is for what? The market price, and E is for earnings per share. Sababu umesema basi sema recall that PE ratio equals to market price per share over earnings per share. P is for the market price, E is for the earnings. Or hii ya share moja. Kama tunatumia shares zote, we shall talk about the market capitalization. Market capitalization. Market capitalization is just a big name which means the total market value. Total market value. We divide by the profit after tax. We divide by profit after tax. And preference dividends, of course. Profit after tax and preference dividends. Ile profit tunabaki nayo baada ya kulipa tax na pia kulipa preference dividends. The profits attributable to ordinary shareholders. Sasa kwa lugha nyingine tunaweza tukaita net income. The net income. Now, if you're using the one share, it is the price of one share divided by the profit of one share. Price per share, profit per share. If you're using all the profits and all the shares, the total market value divided by the total profits. Now, in valuation, this is what we are looking for. Valuation is about the market value. So from this, I can get the MPS by taking PE ratio times earnings per share. That will give me the MPS. And if I want the market capitalization, if I want to get the market capitalization, which is like the total market value, kama nimepewa price ya share moja, I can take the market price per share, I multiply by what? Number of ordinary shares. If I have the price of one share, right? And I also know that from my formula, I can also take the PE ratio. I multiply by what? The profit after tax and preference dividends. It's the same thing. It's the same thing because najua vizuri from my formulas of earnings per share. The formula of EPS. EPS equals to profit after tax and preference dividends divided by what? Number of ordinary shares. So this profit after tax and preference dividends, sitakuwa earnings per share times the number of shares. Asindiwa hii. Number of ordinary shares multiplied na market price per share. It comes back there. It comes back there. So PE ratio, profit after tax and preference dividends times the PE ratio will give us what? The total market capitalization. Because if I multiply by the earnings per share, I get the price of one share. So under the PE ratio model or PE ratio method, our target is to get the market value. And to get the market value, you take the PE ratio, you multiply by the profit after tax and preference dividends. Na tumesema kuwa hii pia tunaweza tukaita nini? Net what? Net income ama net earnings. Number two, net assets method. The net assets method. Then we say it uses the balance sheet equation. It uses the balance sheet equation to determine the value of equity. To determine the value of equity, which represents the value of the target firm. Determine the value of equity, which represents the value of the target firm. i.e., remember the balance sheet equation, capital equals to total assets minus or plus? I'm one of the above. Total assets, is it plus or minus? Hapa tapiga kura. Nasikia zote ziko na sana, nasikia plus iko na minus iko na. Capital equals total assets minus the total liabilities. Na kwa hiyo capital tuko na preference shares and the ordinary shares, equity and preference shares. That represents the capital. We need only equity. So therefore, to get the value of equity, we shall take the total assets minus total liabilities. Then we also subtract preference share capital. Preference share capital. So the value of a firm is, by the way, I didn't mention this, that the value of the firm is always associated with its shares. When you want to invest in a company, you buy its ordinary shares. How much a firm is valued at is represented by the value of its ordinary shares in the market. That's why even under the PE ratio, we are looking for the value, the market price, the value of the shares on the market. That's how. So even the net assets method, we are looking for the value of the firm, which is represented by what? Equity. The valuation of a company is always about the equity. Because if you want to own any company, you own a company by buying its shares. Yeah. Number three, Gordon's dividend growth model. Gordon's dividend growth model. So Gordon's dividend growth model. Then hapa, for a non-growth firm, non-growth firm G equals what? A firm that does not grow, the growth rate is 0. Ndio. By the way, sitaki kuandika formula ionekane mpya. Unakumbuka formula ya KE? Was equals to DO. Wachana tumie D1 over PO plus what? Plus G. Na tumesema G equals to 0. So from here, by the way, Can you make PO the subject because PO is the market price? You make PO the subject? Hesabu ya haraka haraka, sio? Nipa amesema PO equals to D1 over KE. Na hiyo G nayo? Tumesema G ni 0. Lakini tumeiweka. Anyway, tunaweza anza na kutoa hii G huku, to subtract G, kuja pia hapa to subtract G. Tutakuwa na KE minus G equals to D1 over PO. Multiply by PO, multiply by PO. Then divide both sides by KE minus G. Divide by KE minus G. So this one is going. So therefore, our PO equals to D1 over KE minus G. And let us appreciate that for non-growth firm, G equals to 0. So which means the PO is going to be D1 over KE. So which means that for a normal growth firm, PO is going to be what? D1 over KE minus what? KE minus G. Can I also use DO? DO into 1 plus G over what? KE minus G. Naiba nakumbuka difference ya DO na D1? DO is about what? Current, historical or future? DO is about historical, currently, just ended. D1 is about future, next year. Now, but let's say my future manishi next week. I think that one will clarify. Future is not about next month. Future is about next year. So if they tell you that the company expects to pay dividends of 5 shillings in 2 weeks' time, it can never be D1. It will always be what? But for it to be D1, they must be representing next year in a year's time. So I must clarify what is the time. Assignment the company expects to pay without clarifying the timelines, then it will be D1. Lakini examiner kwa na ujinga yake, the company expects to pay na anasema in 1 week's time. Because it knows under the pressure ile na kwa exam room, very many people will confuse because amona tupo expects to pay, wataweka D1. Na hiyo kitu ataiangalia sana, atafute vile ananyorosha watu. So be careful. So that is for a normal growth firm. What of a supernormal growth firm? Aweka dash ingine. For a supernormal growth firm, the value of the shares, stroke intrinsic value, the value of the shares, stroke intrinsic value, into brackets PO, shall be the total of 2 components. Shall be the total of 2 components. Number A, present value shall be the total of 2 components. Number A, present value of expected dividends. Present value of expected dividends into brackets D1 up to the point of stability. Present value of expected dividends, that is D1 up to the point of stability. Na tuna appreciate hapo chini kuwa D1 equals to DO into 1 plus what? Into 1 plus G. And the supernormal growth rate inamaanisha kuwa the dividends are growing at different rates. Napata for the first 4 years, the growth rate is very high at 20%. The next 3 years, it reduce maybe to 12%. Then after the 3 years, it stabilizes at 6% forever. So up to the point of stability, we look for the present value of the expected dividends, our D1. Then number B, present value of the shares. Present value of the shares. That is PO. Immediately after stability. Present value of the shares, PO, immediately after stability. Na tunajua kuwa PO equals to DO into 1 plus G over KE minus G. So PO is the DO into 1 plus G over KE minus G. There's a question that was tested. Ini concept ya baby class. Tunataka apply hapa. Let's check the first paper. May 2019, question 2B. May 2019, question 2B. ABC Limited, there. So you're told that ABC Limited is a company 12%. The growth rate is likely to be 10% per annum for the third and fourth year. So this one becomes a supernormal what? Supernormal growth farm. It is growing at different rates. Ndio. Miaka mbili za kwanza 12%. Miaka zingine mbili 10%. Then it will stabilize at 8% per annum in perpetuity. So stability is coming in after how long? After the 4 years. Yeah. After the 4 years. The last dividend to be paid was 1.50. PO ama D1? PO. Required rate of return is 16%. Your cost of capital. Then they're giving us some 4 marks to come. So we have the year. We have the year. Tunataka D1, which equals to DO into 1 plus G. And because you're talking about the present value, lazima to discount the PVIF. Cost of capital, is it 16%? The D1 is in shillings. We shall look for its present value. Miaka mbili za kwanza, mwaka wa kwanza na wa pili. Tukianza mwaka wa kwanza, DO ni ngapi? Tukianza mwaka wa kwanza, DO ni 1.5. Growing at what rate? It's growing at 12%. So can I say 1.12? To get the D1. Reflection inasumbua. Nisome gani? Kwa sawa. So D1 becomes 1.68. So D1 becomes 1.68. When I start my year, what is the D4? So 1.68 growing at, it is still at 12%. 12% was in year 1 and 2. So is the D1. So the answer that you have times 1.12, 1.88. So I have the first 2 years 12%, another 2 years 10%. So I have year 3 and year 4. So in year 3, my D is it 1.88? Growing at what rate? So by the way, usipute answer yako to avoid the rounding off errors. Cheza nayo vile iko. Like ya kwanza najua nilifanya 1.5 times 1.12 kwa 1.68. I'm very sure the 1.68 could be multiplied by 1.12. Hii umeround off. So to avoid the rounding off errors, usi cancel. Your answer uko nayo to multiply by 1.1. So that don't do 1.88 times 1.01. Your answer itakuwa na rounding off errors form. Don't you forget my point? Yeah. Continue with your answers as they are in the card, even though you are rounding off. It reduces the errors of rounding off. Answer yako itakaribiana na marking scheme. Ama itakuwa sawa na marking scheme. 2.07. So we have 2.07 still growing at 10%. So times 1.1. 2.28. So the present value of expected dividends up to the point of stability. Miaka mbili za kwanza 12%, miaka zingine mbili 10%. After that, ina stabilize at 8% forever. Now, immediately after stability, that is immediately after year 4. And I'm really underlining this one immediately. So immediately after year 4 is the beginning of year 5. But cash flows don't accrue at the beginning of the year. Cash flows accrue at the end of the year. So the value at the beginning of year 5 will be the same as the value at the end of year 4. So I don't put here year 5, but I put here another year 4. But it is representing 1st January of year 5. Balance brought down is the balance carried down. So immediately after 4 years is the beginning of year 5. I cannot value any figure at the beginning of the year. That's why the balance sheet inakwanga as at 31st December. Even income statement is for the year ended. Hakunanga for the year beginning. Cash flows always accrue at the end of the year. So the value at the beginning of year 5 will be the value at the end of year 4. Sawa. Na sasa hapa staki D1, nataka PO ambayo ni DO into 1 plus G over KE minus what? KE minus G. Sasa, but remember I'm in year 5. My DO now becomes this 2.28. Now growing at what rate? So can I say 1.08? Right? Divided by KE. KE ni ngapi neighbor? Neighbor naona 16. Minus G of 0.08. What is that? We align it to this. $30.75. 74. So hizo cash flows ni lump sum ama ni annuity? Table 1 ama table 2? Nasikia tunabaki sema table. Tumekuwa janja siku hizi. To participate you just say table, alafu na relax. But anyway, it's table 1, sindio? 16% 1 year. 1 divided by 1.16. 0.8621. Year 2 divided by 1.16. 7232. Oh, thank you. 7432. Year 3. 6407. Year 4. 5523. Next. Usiende huko neighbor wa 8. Usiende huko. Year 4 ziko mbili. Naingiza box na mnaingia. Then at our level, usianze kunipea hii answer mara hii. Tumia calculator. Leta the final answer. This times this plus this times this plus this times this plus this plus that one becomes the intrinsic value. Pretty. 22.43. Now this mergers and acquisition, it has two key formulas. Anything that happens other than the two formulas will now fall in these other topics of investment decision and financing decisions. So let's have let's say this. Two key formulas. Two key formulas are associated. Two key formulas are associated with mergers and acquisition. Two key formulas are associated with mergers and acquisition, i.e., number 1, maximum exchange ratio. Maximum exchange ratio. So it is the ratio of exchange between the shares of the predator and the target. So this one we have offer price equals to offer price of predator divided by the MPS of predator. Offer price of the predator divided by the market price per share of predator. Alafu formula ya pili ni non-dilution. Non-dilution offer price of predator. Non-dilution offer price of predator. Non-dilution offer price of predator. Can say something before I put down its formula. It is applied when The predator, it is applied when the predator does not expect to dilute. When the predator does not expect dilute, stroke reduce its earnings per share. Stroke reduce its earnings per share after the merger. After the merger. Then you can say non-dilution offer price of predator equals non-dilution offer price of predator equals non-dilution offer price of predator equals pre-merger PE ratio of predator times pre-merger EPS of target. Pre before. So pre-merger PE ratio of predator times the pre-merger earnings per share of target. We are borrowing it from the formula of PE ratio. So for PE ratio, when you want to get the market price per share, we take the PE ratio times what? Times the earnings per share. So the PE ratio of the predator times the earnings per share of the target before the merger. So now you can do questions. Can now do questions. Mergers pia imetestiwa karibu kwa kila sitting. 5 key topics, 5 key questions. We are now in topic number 4 out of the 5. So mpaka penye tumefika, by the way, unafaa uko pass. I'm very keen on my word. Unafaa kuwa ushapita. Sijasema kuwa ushapita, unafaa. Tulisema theory bado mja-download. So kuhakikisha tumepita lazima kwanza na download theory. Sindio? Because in each of the 5 topics pia kuna theory. But there is this paper called AFM. Can you pass it without theories? Kwa kufanya tu hesabu peke yake? Utaki kujibu lecture uko sure? Ni first time. Ni first time uko na bahati. Umeona vile nimekuangalia, wewe ni time yake angapi? Can you first time yako count yourself lucky? Consider yourself to be very lucky. Kuna mtu karibu give up na kutoa hapa ndani. Please don't give up. This should be your last attempt that you pass. Ziko tu hapo ndani. Haya, tuangalie maswali. We can start with last sitting. So August 2023, naona mergers for question number 4B. So question number 4A was the lease or buy, then financing decisions. Question 4B, August 2023. Order page number 3. Still. Now, The statement of financial position of two companies, August 2023. August 2023. The statement of financial position of two companies, A Limited, Acquistion Limited, and Bero Limited, as at 31st December 2022, are shown below. So tuna Acquistion na tuna Bero. Ordinary share capital, the par value is 10 shillings. Preference share capital, share premium account, profit and loss account balance, 10% debentures. Then we have the non-current and non-current assets, and of course, the net current assets. Acquistion is proposing to acquire Bero Limited by means of an issue of its own ordinary shares in exchange for the ordinary shares of Bero Limited. So the predator ni nani? Predator ni Acquistion, sindio? And of course, Bero becomes the target. And now the form of acquisition is share for share transfer. We want to give them our own ordinary shares in exchange for the ordinary shares of Bero Limited. The management of the two companies have availed the following information to assist in the takeover. Maintainable annual profit after tax attributable to equity holders. That is our profit after tax and preference dividends for Acquistion and for Bero. Current market price per ordinary share, current earnings per share, tax rate is 30%. Using the following valuation basis and assuming no synergy effects accrue from the takeover, synergy ni level inasema 1 + 1 = 3. Synergy unajua hiyo ni the benefits of coming together. It leads to some synergistic savings. When two companies come together, there's a lot of savings that you're going to have. Ingekuwa kampuni kivyake, administration office ingekuwa, each company would have its own. By coming together, so you are likely to have only one office. So you're saving on some costs there. There are some decisions that you're also going to make which are more prompt and very, very fruitful, because mostly the reason of us merging might be because ile kampuni ndogo tunaona iko na good management team, and we need to absorb that knowledge. So synergy, 1 + 1 = 3. Ile kwa nasema 2 is better than 1. Yeah, so that's why we are encouraged to come together and form families. Anyway, so using the following valuation basis and assuming no synergy effects accrue from the takeover, determine the total number of shares the directors of Acquistion Limited will have to offer to the shareholders of Bero Limited. Ya kwanza ni net asset value basis. So net assets value basis. But the concept on this, first of all, we need to get the maximum exchange ratio. We are comparing the offer against ours. Now, when you talk about the maximum exchange ratio, was about the offer price of the predator divided by the market price of the predator. That is the standard formula. Sasa examiner anataka tutumie the same concept by bringing in the net assets value of the target, comparing with the net assets value of the predator. So under the net assets, tukianza na ya kwanza, wanataka tumie the net assets. So here, mwambie tu kwa maximum exchange ratio is going to be net assets of the target. That is what we are offering. That's what we are going to buy. Target wetu ni nani? Si Bero. So net assets of the target, that is Bero. Then we divide by, so net assets of target divided by the net assets of who? Net assets of predator. It's just a comparison between the two. The denominator is the predator. the net assets of the net assets basis. So it's just a comparison between the net assets of the two companies. The company we are acquiring with our own company as the predators. Tukienda kwa the second one, the earnings per share basis, we shall also compare the earnings per share of the target divided by the earnings per share of the predator. Sasa tukienda kwa hiyo nyingine, market value basis, we shall compare the market value of the target with the market value of the predator. The same way, the present value of the future earnings. The earnings of the target over the earnings of the predator. Now, do you have the net assets of the target? Target ni nani, by the way? Ni vizuri kuweka kwa brackets. Target ni Pero. Na predator ni nani? Apple. And do you remember the formula of net assets? Net assets will be equals to, haijabadilika by the way. Na si criminal kurudi kwa archives, sini zako. So the target, the net assets equals to total ngapi? Total assets, is it 6100? That is our total assets. Do you have the liabilities? Debentures of how much? 500. Do you have anywhere current liabilities? And do you have the preference share capital? That's okay. So that gives us the net assets of the target. Total assets minus total liabilities minus preference share capital. In simple terms, we are looking for the equity. Kwa hiyo balance sheet equity ni ngapi? Sini 5 million plus 200 the share premium plus profit after plus the retained earnings of 400. So the net assets of the target. Do you have the net assets of the predator? Total assets of ngapi? 17,300 minus, we have the liabilities, debentures of how much? 1,500. And then we have the preference share capital of 2,000. Yeah. That one becomes 6,100 minus 500 is 50 watts. So 5,600 divided by 13,800. 13,800. That one becomes 0.41. So 0.41 over 1. Tachana na over 1. I just confused. 0.41. Now, that is the ratio of exchange. That is the ratio of exchange. Just make a statement hapo chini alafu seme Acquistion Limited is offering Acquistion Limited is offering 0.41 new shares. Acquistion Limited is offering 0.41 new shares for every existing share of Pero Limited. For every existing share of Pero Limited. So how many shares that Pero Limited have? Number of existing shares. Is it 500,000? 5 million divided by what? Divided by 10. So 500,000 shares. So swali ni, the question was asking about using the following valuation, blah, 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 determine the total number of shares the directors of ACO will have to offer the shareholders of Pero. Kama kwa share moja ambayo wako nayo, tutawapea 0.41 new shares. How many shares are we going to give them out of the 500,000 shares that they have? Sieni mathematics. Kila share ambayo wako nayo, tunawapea shares ngapi mpya? 0.41. For every one existing share, we are offering you 0.41 new shares. How many new shares are you going to get out of the 500,000 existing shares? So simply saying, we are offering 0.41 for everyone. Out of how many? 500,000. So how many new shares are you going to have? 2 or 5,000. Those are the new shares. Is it too much work for 2 marks? Watapeana marks in nne. Tatu. The difference is only 1 mark, not bad one. Haya. Lakini zinakuanga marks kidogo kama unajua, sio? Kama unajua unasema after all it's only 2 marks. Sitajitesa kwa sababu ya marks 2. Now, using the EPS basis, so the maximum exchange ratio equals what? EPS of who? EPS of target divided by EPS of predator. We have the EPS of target. Now formula EPS equals to profit after tax and preference dividends divided by what? The number of ordinary shares. It's the earnings per share. Earnings per share. So together now target. We have the profit after tax and preference dividends of target of ngapi? How much? The eyes don't have it. The target ni ngapi? 1.5. Sindio? Na shares that target kwanza. Target ni Pero. 1.5, right? Ukiona unaonyesha neighbor, masaa imefika ile target. So be considerate. God blesses us in different ways. Tukianza class unaona wanakuanga off na unaona wanarudi on tukimalizia. Na tunaona wako on tukianza wanaenda off tukimalizia. Thank you, neighbor. So EPS ya target ni ngapi? 3 shillings. Predator 9. PHF predator ni ngapi? 2.4 million. The number of ordinary shares? 10 million divided by 10 still. So you're having 1 million shares. So this one becomes 2.4. So can we have its maximum exchange ratio? Sorry. The preference? That is the profit at the maintainable annual profit after tax attributable to ordinary shareholders. is the same word for the profit after tax and preference dividends. Una less the preference dividends. So therefore, the maximum exchange ratio the earnings per share umepata 1.25. So 3 divided by what? 1.25. So how many shares are we giving for everyone? Just make a statement. Then you say, Acquistion Limited is offering 1.25 new shares. Acquistion Limited is offering 1.25 new shares for every existing share. For every existing share of Barrow Limited. So number of new shares would be what? We are offering 1.25 for everyone. Sindio? Out of shares ngapi ambazo wako nazo? 500,000. So that gives us how many shares? 625. So number 3. Number 3, they're using the market value, right? The market value basis. So the maximum exchange ratio. The maximum exchange ratio becomes market value of target divided by what? Divided by the market value of predator. Market value of the target divided by the market value of the predator. The market value is on a market capitalization. We have the value of 1 share of target. The market value of 1 share. Is it 10 or 27? It's not the par value, the market value neighbor. 27, sindio? With the number of shares ambazo ni ngapi? 500,000, sindio? So therefore we are having 27 times 500,000 divided by the market value of the predator. I think 24. With how many shares? 1 million shares. So what is the exchange ratio? Zero point 0.56. Hiyo explanation tulikuwa tunapeana, si lazima upeane. Sisi tumepeana to try and interpret it and understand it. That's how. And from our interpretation, we know that we are offering them 0.56 new shares for everyone that they have still. So therefore, can we have the number of new shares? So difficult to be having a class close to the kitchen. So 0.56 new shares for everyone, right? Out of how many shares that they have? 500,000. Makes you remember that you didn't have lunch. How much? 281, 250. 280, 250. 281. So if you don't round off, it comes to 81, 250. Andika hiyo. Andika hiyo umepata. Lakini usiandike shillings, shares. Hata ukiandika hiyo umepata. Umetoka kwa kazi. Never doubt your calculator. Wanze kuangalia jirani. Then finally, they want us to get using the present value of future earnings basis. So number 4, present value of future earnings basis. Now, ukitumia stories za hii tuli round off. Sindio? So try to avoid rounding off in the final exam. Sasa marking scheme hainanga rounding off. Kwa na avoid. So utaka kupata kama marking scheme, jaribu ku avoid rounding off. Sasa when you round off at least kwa nasema at least 3 decimal places. At least 3, but if you can avoid the better. Sasa hata baada ya round off sababu maandika 0.56, sio answer bado iko kwa calc. So you can do direct without using that one, utumie ile iko kwa calc. Vile tulifanya ile ya supernormal growth rate. It reduces the rounding off errors, good for you. Jana kama wakati ule jamaa na mark paper yako amebit. Anaanza kutafuta maswali answers zenye zinafanana na marking scheme. Now ikishakuja ni fail, do you have the courage to request for remark? Hata ukiuliza Wafula atakwambia please don't waste time. We start with the money, sio? Alafu wakati wana remark, kwa remark mbele yako. The only thing that will happen is if Wafula is the one who failed you, will not be given that paper to remark. Obviously, nikimark paper yako lazima ni sign kwa mimi ndo nimemark. Kwa zinakwanga kwa ile big envelope. Hapo kwa big envelope wakati when your center has like 80 candidates, I'll be responsible for all the 80 candidates in that center. So nikisha mark for all the 80 candidates lazima ni sign hapo kwa envelope kwa marked by Wafula. So when you apply for remark, si wanajua penye paper yako iko because they know your center. They go to that center, who mark this center, Wafula mark this center. So they get another Wafula B. Mwenye pia ni marker wa AFM. Bila kuinform Wafula A. But you think my colleague can fail? Because checking the consequences. If I wronged you, kama nilikunyorosha, mwingine akuja mark akupitishe. Number 1, job yangu imedai. Number 2, I become responsible for any suit kama utashtaki customer. So do you think if I have good rapport with my colleagues in the marking center, wanaweza taka nipitie hayo yote? Uko sure hatujuani? Na tuna mark kwa table moja. Sasa nyinyi ndio mnaumia. Shit happens. Ndio. Shit happens and it happens mostly ukipata sasa story kama hizo. Unajua mtu akiremark na akapata hapa inafaa ikuwe 281 na uliweka 280 because rounding off errors. Marking scheme imeonyesha 281. Nikikunyorosha nimekosea. Na nimeenda na marking scheme. Even if customer asks me, I'll tell them, but what did the marking scheme say? And it was coordinated and approved at the marking center. Don't know if you get my point. Formula unaweza pata marks za formula. Because unajua, by the time unafikiria ku remark, Under normal circumstances unakwamba umenyoroshewa kwa 46, 47. Wezi kuwa ulinyoroshewa kwa 25 unafikiria remark. Ukachua ujuange kama ulipata 10 out of 100. Ukifika stories za remark wewe ni mtu anajuanga ilikuwa nipite hii pepa. Na uwezi kuwa ulikuwa upite na ulipata 10, 20. Kama ulikuwa upite, kuna vile wamekunyoroshia somewhere kwa 45 ikienda juu, sio? 45 ikienda juu. That's why you deserve somebody to relook at it. Na wakati wa kuremark wanaangalia hata spelling, grammatical errors. Na umekataa kusoma ndio, unangoja next week part 1. Ndio usisahau, sio? Now number 4, the present value of future earnings basis. So hapo, by the present value is about discounting. Ndio. Ukiangalia kwa hiyo swali hatujapewa cost of capital. But I know if I discount the earnings of the target and I discount the earnings of the predator, discounting factor itakuwa the same. If it's 12% 1 year, na ingine pia ni 12% 1 year, see the PVIF na PVIF ita cancel out. So jina present value ni kelele. You have to koroga bure. So here you simply look at the earnings of target, earnings ni sawa na profit after tax divided by what? Earnings of predator. We have the earnings of target of how much? The target ni 1.5. As a predator ni ngapi? 2.4. What is our exchange ratio? 0. 0.62. 624. 625. So therefore, number of new shares we are giving out 0.625 shares for everyone. Out of how many that they have? 500,000. How many shares are those? 312,500. Na hizo ni shares. Now check April 2023, question 2. April 2023, question 2. So wakati theory umeshindwa kuzisoma, hata wakati mwingine tumia Google to differentiate between white knight and white square. Don't let that bobo. Now, Felix has collected the following information relating to the pro forma financial statements of ABC Limited, a company that is a target of its competitors. Pro forma statement of profit or loss, revenues from 2022 to 2026, cost of goods sold, gross profit, selling and general expenses. We have depreciation earnings before interest and tax. We have the net interest, earnings before tax. We have the tax and we have the net income. Change in deferred tax income. So the selected pro forma statement of financial position, change in deferred income tax, then balance sheet, then change in net working capital. That is the cash flow statement, net working capital, and we have the capital expenditures. ABC has a corporate tax rate of 30%. The weighted average cost of capital is 10%, and the terminal growth rate is 6%. Determine using the discounted free cash flow analysis the value of ABC Limited. Discounted free cash flows. So discounted free cash flows, we discount the cash flows. There's one thing that examiner aliweka hapa kama catch. Depreciation. Is depreciation a cash item? Depreciation is a non-cash item. So for you to convert your profits into cash flows, because add back the depreciation. So kwa hiyo income statement ambayo tuko nayo, there's one thing that we must do. First of all, tuko na profit after tax, the net income from 2022 to 2026. We need to convert those profits into cash flows. To convert profits into cash flows, we add back the depreciation. Sasa, kama tungeanzia pale juu kwa kama tungekuwa tujaless the depreciation, tuko na earnings before depreciation and tax, tunge add the DTS, tunge less the tax, na to add the DTS. Ndio tulikuwa tunafanya kwa investment decisions. But now here, washa less depreciation, tumefika kwa profit after tax. The simplest way to do is what? Add back the depreciation. So, to add back the depreciation, there's a second thing that you must do. Cash flow statement. So many items that affect our cash. Working capital, we are buying stock. When we buy the stock, si pesa inatoka. So lazima pia to adjust for the working capital, the cash flow statement. The items in the cash flow statement, the expenditure, I'm just trying to explain this because you're going to borrow it a lot. Even maswali zingine hata kama si za leo. The capital expenditure. When you're discounting, when you're calculating the value of a company, we need the dividends. Si hata pale kwa PO tulitumia the D1, the dividends, right? How do you arrive at the dividends? You take the profit after tax, you less the retained earnings. Okay, less the retained earnings, unabakisha the dividends. Is your neighbor still here? Ama shafika stage? Eno wakati unaenda stage, ndio tunasemanga vitu zinakuja exam. Shetani naye ni nani? Anajua vile huwa anakufanya. The profit after tax, wakula ashindwe sio? And preference dividends, tuko nazo hapa. Like let me take 2022, tuko na 2296. Valuation, hata tukifanya DO, tulichukua DO into 1 plus G. Hatukuchukua PAT, tulichukua dividends. Sindio? From this figure, if I less the retained earnings, will I get the dividends? Niachane na maribas. Kama hebu umeconfirm timetable iko? So profit after tax equal 2296. I'm supposed to less what? The dividends. Ndio. If dividends are 1000, then the retained earnings ni ngapi? 1296. The retained earnings for anasema it is the retained earnings for reinvestment purposes. We pay out the dividends of 1000 and we retain 1296 for reinvestment purposes. So that is the interpretation of the retained earnings. You retain it so that you can invest. You pay out the 1000, you retain the 1296 for investment purposes. So for investment purposes, hizo capital expenditures. So tumepewa retained earnings kama za huu mwaka, tumeambiwa retained earnings ni 1461. Can we get the dividends? Utapata the dividends for subtract the 1461. Whatever remains is now your dividends. Sendio.
So you mean capital expenditure in the interpret kama itenga.
Exactly. We retain so that we can invest. Where do we invest? In capital projects. Sasa. We just set the question the way it is, then we utamalizia kwa homework. Leo nikupe homework. Ukikuja kama hujafanya sitakasirika. Nimezoea. Ningekuwa nilikasirika kitambo. So, tuko na maswali zingine zikitestiwa kama hii, zinakuanga za kutisha, lakini zinakuanga free marks in my interpretation. Hizi zinakuanga maswali za free marks. Watu wengi huziogopa because of a lot of wordings and a lot of information, but they are naturally free marks. When you kutengeneza income statement, add back the non-cash items, less items of the cash flow statement. Like now, document hizo years. Tuko na 2022, 2023, 2024, 2025, and 2026. The figures are in thousands of shillings kila mwaka, in thousands of shillings. Examiner shatengenezea income statement. So tuanzie kwa net income. We have net income of 2022. 22 ngapi? 96. We have 2584. We have 2904. We have 3258. And we have 3651. Hiyo ni profit. Tunataka the cash flows. Tunataka the cash flows. So we add back what? We add back depreciation. We have depreciation of 2022. 5 ngapi? 551. The next is 606. Then we have 667, then 7. 734 finally. 807. Usishika taka kwanza. Then there's any other item that affected your cash flows. Na hiyo ni nini? We have the working capital. Working capital changes. Working capital ikiongezeka inamaanisha nilispend. Na zote naona ni positive, meaning zimeongezeka. So I less in 2022 working capital iliongezeka na ngapi? So I less ni kama stock iliongezeka. Stock ikiongezeka nimespend. Sindio? Stock ikipunguka inamaanisha nimesave. Pesa imeingia. Sawa. The current assets in excess of current liabilities. Ingekuwa negative, tungeweka positive. May add. So next is 551. 607. 667 and what? 734. It is increase in working capital. Increase in working capital, cash is going out. So it's a cost to me. Decrease in working capital, cash is coming in. We are saving. So it would be a positive to me. Here to get add. So working capital equal positive, that is a cost to us. Working capital equal negative, that is a saving to us. Hi. then we less capital expenditure. Na hiyo capital expenditure kwa lugha ya mwananchi tumesema ni nini? The retained earnings. So in 2022, by retaining 1461. Hiyo nyingine ni 1709. Hiyo nyingine ni 1880. 2068. 2275. So this one now becomes, we can call them the dividends, or you can call them the net cash flows. Sasa change deferred tax in your balance sheet. We are dealing with the cash flow items. Share effect already over income statement. The interest is already in the income statement. So you're only dealing with the items that affect our cash flow statement. Sasa, so deferred tax ni kelele. So you can call this one as dividends. We can call it net cash flows. Bila utaamua kuita. So these are net cash flows, which is the same as the dividends. In 2022, 931. 2023. 930. 2024. 1084. 2025. 1257. Finally. 1449. So because ni swali la kwanza la of this nature, let me wacha ni interchange isimamishe sasa. Ndio tu apply ile concept yenye tumeifanya leo. Wamesema angalia kwa swali kidogo before to conclude. Wamesema the terminal growth rate is 1%. So for the 6 years, the dividends or the earnings are growing at different rates. Then after the 2026, it stabilizes at 6%. So we discount the cash flows up to the point of stability. Then we add the present value immediately after stability. Paper, ako present. Tuko na the year, tuko na cash flows. Tunafanya the PVIF so that we get the present value. So the figures are in thousands of shillings, no problem. Cost of capital, the WSC of the company was ngapi? So 10%. So we are not valuing the shares, we are valuing the company. That's why we are not using the KE. We are now using the WSC. We are valuing the entire company. That's why we are using the WSC. So 2022 will be my year 1. 2023 will be my year 2. 2024, year 3. 2025, year 4. 2026, year 5. So in year 1, are we saying 931? Right? In year 2, are we saying 930? In year 3, are we saying 1084? In year 4, are we saying 1257? And in year 5, are we saying 1449? Then we have another year 5, where we now apply the PO. PO into 1 plus G over KE minus what? KE minus G. But I repeat, we are not using KE, we are using what? The WSCC. We are just borrowing the same concept. That's how. We have our DO. 14 ngapi? 1449, ndio. Neiba amefika mahali pa photocopy. Akisema atajulia mbele. Now growing at the rate of 6% after the stability. Ndio. So can I say 1.06? Yes. Divide by, what is the WSCC? So 0.1 minus 0.06. Tumetumia WSCC, swali nimesikia. Tumetumia WSCC kwa sababu we are not valuing the ordinary shares, we are valuing the firm. So we are using the cost of capital of the company. Sasa, alafu bahati mzuri kwa hii swali ni kuwa KE hatukupewa. Kama tungepewa KE watu wangenyoroshwa. For example, alikuwa fair kwa wanyima KE. So that by all means kutumia WSCC. Kuna maswali zingine kwa wanapeana KE na pia wanapeana WSCC. Uchague ya kutumia. We are valuing the company, we are not valuing the ordinary shares. The company is about the cost of capital, WSCC, because it has debt. And it has, like in this one, we don't know. Probably it has debt and maybe it has the preferred shares. So it discounts the cash flows using the cost of capital. So hii ni ngapi? Neiba nataka kuandika 38, 39. Like that. 38, 398.5. Table 1 ama table 2? Table 1. Unaweza malizisha? Malizia moja kusema ili niende. Ha? Utamaliza? Kama utamaliza basi ni 0. Ya 89 kwa skili imetoa 9091 8264 7513 6830 neiba kopa tu. Bado moja neiba 60 6209 alafu pia inakuwa 6209. So that is your 10 marks. So you multiply this times this plus this times this plus this times this, get the value here there. So that is the value of LDC Limited. So you can check August 2022, question 2B. August 2022, question 2B. So unless there's a question, we can stop there. August 2022, question 2B. Thank you, sweet. Have a good night. Okay. Out confirm answer. Neiba shafunga kitabu, kalamu iko kwa bag. 28,029.18 naiba andika. Najua hujafinya mahali. 28,029.18. Don't say we didn't tell you.